Okay, hi everybody. Welcome to our Chapter 9 video. Chapter 9 focuses on shareholders' equity section of the balance sheet. And this is an example of a little bit more detail with the shareholders' equity section than we're used to seeing. So what we have here in addition to common shares and retained earnings is preferred shares. So first I want to talk about the difference between preferred shares and common shares, and then we'll talk about some of the journal entries with things that happen in the shareholders equity section, and then I'll show you how to update the shareholders equity section from one year to the next. So just as far as the content of this shareholders equity section, so we have our common shares, which you're used to seeing, but there's usually a description after the common shares. In this case, we have an unlimited number of shares authorized. That means that when the company was formed, the corporate documents to set up the company specified that the company could issue as many shares as they needed to, unlimited number of shares. Just quickly, up in preferred shares, we have 500,000 shares authorized. That means that the company could only issue 500 shares at a maximum over the life of the company. So back to common shares, we have 1 million shares issued and outstanding so far as of this date, the end of 2018. And so that just means in the course of the company's life up to 2018, they have issued 1 million shares so far and received $10 million for those shares. So on average, they would have received about $10, not about, but $10 a share on average. So this is the number of shares that they've issued so far. And this, of course, is the dollar amount that we would list on the balance sheet. So up to preferred shares. The description says preferred shares. This is the amount of the dividend per share of a preferred share per year. So if you are investing in this company and you buy 10 preferred shares, you would receive $1 per share for each share that you own in the run of a year. So it'd be $10 per year. The next item is the number of shares authorized. The next item, so it's basically 3 items here in this description of the preferred shares. We have 200,000 shares issued and outstanding so far. The maximum that we could issue of 500,000. So the amount of money that we got for these 200,000 shares was $4 million. So once again, this is the number of shares that we have issued and outstanding, and this is the dollar amount. There's an important difference between preferred shares and common shares. So preferred shares have a stated dividend amount. In this case, it's $1 per share. Common shares do not have a stated dividend amount. So the common shareholders may or may not receive a dividend. Usually they do. In reality, there's a dividend amount. They usually get one every year. That's paid usually 4 times a year. However, it's not a stated amount. With preferred shares, it's a stated fixed amount that doesn't change over the life of these preferred shares. The other important difference between preferred and common shares is that if there's only a set amount of cash for the company to pay all of the dividends, both of these share types, preferred shareholders get their money for the dividends first. And if there's any money left over, the common shareholders will get their money for dividends. So just the way the shares are described, preferred, they get their dividend money first. Again, if there's money left over, the common shareholders will get some dividend amount. Okay, so I think that's all for the main differences between preferred and common shares. What I'd like to do next is show you a few examples of what might happen in this shareholders' equity section and how to write journal entries for various events. So we have some examples of things here that might happen in this part of the balance sheet. So this balance sheet here was as of the end of 2018. In 2019, we have 4 items. The first one, February 1st, the company issued 100,000 $1 preferred shares. So again, the $1 is a description of the preferred shares, which means these preferred shares have a $1 dividend per year. And we issued 100,000 new shares. So this is the number of shares. And they were issued for $10 per share. So that means that we are going to get $1 million for this issue of 100,000 shares. So the way we would write this journal entry is, I'll show you here, it's 2019, jot down the date. We're going to receive cash, 1 million. And we're going to record an increase to our preferred share account. That's a good abbreviation if you'd like to use that rather than writing out the full account name. So it's as simple as that. We get cash and we increase our preferred shares. So that's good for that one. For the next event in our shareholders' equity, March 31st, 500,000 common shares were issued in exchange for 5,000 cash. So nothing fancy here. We'll just jot down that we received cash of 5 million. And we increase our common shares by $5 million. So just when you're doing these types of questions, make sure you keep number of shares and dollar amount of shares very separate. So of course journal entries record the dollar amount. Your balance sheet records both. So dollar amount here where you would normally put it on your balance sheet, number of shares in the description after your different types of shares. Okay, so the next event was preferred share dividends were declared and then they were paid about a month and a half later. So before I show you the journal entry for this, I just want to talk about how dividends work. All right, so when we have dividends, it's not quite as simple as just saying, okay, we're going to pay a dividend and we pay it. There are actually 3 dates associated with dividends. So the first date is the date of declaration. That's when the company says that they're going to declare a dividend. And so they're committed to it, and we write a journal entry on that date, which I'll show you in a sec. The second date is just sort of for your information. We don't really need to know it just for the accounting part of it, is the date of record. And that's when we get all of the shareholders' names. There's always a lot of buying and selling of shares, but we get the names of the people that own shares as of this date, so those are the people that will get the dividend. The last date is the date of payment, and that's when we pay out the cash. And there's a journal entry for that date. So there's no journal entry for the date of record. So in this example here, our date of declaration is July 1st. We don't know the date of record. It's sometime shortly after July 1st, maybe the 10th or 15th. And then the date of payment is August 15th. So I'll show you those 2 journal entries for our dividends. So on July 1st, we're going to take our dividends, as you know already from doing shareholders' equity statement of changes in equity, we take our dividends out of the retained earnings. And so we need to get an amount for the amount of preferred dividends that we're paying. We'll do that in a second. On on the date of declaration, we will set up a payable account. So this is a preferred dividend, so we're going to call this account preferred dividend payable. Okay, so what amount are we paying out in dividends? For the preferred shares, we need to go back up and see what the amount is per share. It's $1 per share, and we need to look at the number of shares that we're paying. So we started with 200,000 preferred shares, but you recall we issued an extra 100,000 shares. So we have 300,000 preferred shares, and we're paying $1 each. So we are going to pay $300,000 in preferred dividends. Okay, I'm just going to review that quickly once more. So for the dollar amount for our journal entry for the dividend, we need to know the number of preferred shares and the dividend amount per share. Once again, dividend amount per share is $1. We started with 200,000 shares. We issued another 100,000 shares, so we have 300,000 shares times $1 is $300,000 in our dividend amount. So the second journal entry to do with this dividend payment is on August 15th. This is when we actually show that we're going to pay out the cash. So we debit that payable account, preferred dividend payable, for the $300,000, and we pay cash. All right, so that's how we record the journal entry for a dividend. If this was common shares dividend, we'd do the same thing, except it would be retained earnings. This would just say dividend payable for common shares. This would be dividend payable and cash. So that's your set of journal entries for the dividends. So date of declaration, date of payment. All right, the next dividend that I want to show you is a stock dividend. So what is meant by a stock dividend? So far we're just accustomed to thinking of dividend as a cash dividend. Sometimes companies want to preserve their cash. If cash happens to be low and they need their cash for paying wages or just paying current bills, they might decide to give their shareholders extra stock or extra shares instead of cash. So it's a great way for shareholders to get a little bit of extra value without the company having to pay out cash. So what happens in this stock dividend, just as an overview, there'll be a date of declaration, date of payment. Date of payment is sometimes called the date of distribution in this case with the stock dividend. But what will happen is the company will actually issue a small number of shares as a dividend. So the number of shares is going to increase with our stock dividend. So it's kind of neat. And what I want to do right now is show you the math of how to calculate the dollar amount for our journal entry of the stock dividend and how to show you the new number of shares that will be issued with the stock dividend. Stock dividends only apply, let me make some notes here, a sec. Okay, just a few things as far as our background about stock dividends. So they only apply to common shares. Preferred shares have the stated dividend. There's nothing that will change that. So we're only going to look at common shares for a stock dividend. They're expressed as a percent. So in this case, it's a 1% stock dividend. So we take the percent and multiply. This is to get the new number of common shares issued. We take the percent and multiply by the number of common shares currently issued and outstanding. And that will give us the new number of common shares with the stock dividend. Once we have the new number of common shares, to find the dollar amount of the new issue, we take the new number of shares, new number of common shares, times the market value per share, per common share, on the date of declaration. Okay, so that looks a little bit more complicated than it actually is, but I wanted to talk about that so you have a record of how the math works. So let's go back to our example. We have a 1% stock dividend in this case. So our 1% stock dividend was declared on October 31st. So we need to think about how many shares do we have on October 31st. So let's go back to the balance sheet. We started with 1 million shares at the end of the previous year of common shares. And we issued another 500,000 common shares. So altogether, we have 1.5 million common shares. We take our 1% stock dividend times 1.5 million common shares, and that will give us the new number of shares. So we're going to issue 15,000 new common shares for our stock dividend. So now we have the new number of shares, new number of common shares. Now we need the dollar amount. So we'll take that 15,000 and multiply by the market value on the date of declaration. So it says on this day, actually in this example, the date of declaration and the distribution theoretically happens on the same day. In reality, they would not be the same day, but it makes our job easier to think about it on the same day as far as the journal entry is concerned. So October 31st, the market value was $11 per share. So there's only one market price to choose from here in this question, but some questions might give you market value on date of declaration, date of record, and date of distribution. You'd have to choose out of the three. Anyway, we only have one to choose from. It's $11 per share. So market value is what it's trading for in the secondary market, which is not related to our balance sheet per share amount. Anyway, the amount we're going to pick on that date is $11 per share. So the shares are worth $11 per common share. So the dollar amount that we need for our journal entry will be $165,000 for the stock dividend. So now we can go back and write the journal entry for the stock dividend. Okay, so this happens on October 31st. Stock dividend comes out of retained earnings and goes into our common shares. So very straightforward when it happens on the same day. And the amount that we calculated is $165. So great. So that wasn't so bad. When it gets a little more complicated is if you have to write the updated balance sheet. So that's our next sort of segment in this chapter, is to show you how to write an updated balance sheet, where we have to track the new number of shares, we have to track the new dollar amount on the balance sheet of both types of shares, and we have to figure out the new retained earnings value. So you can see that retained earnings is impacted here by the preferred dividend, which we paid out in cash, and it's also impacted by the stock dividend, which we did not pay out in cash. An important point here, a the difference between a cash dividend and a stock dividend. In this example, we did not have a cash dividend for the common shareholders, so that's fine. We don't absolutely need one. But there's an important distinction here. So with these two journal entries, the preferred dividend paid out in cash impacted our shareholders' equity section by reducing our retained earnings, and it also reduced our assets, which is cash. However, with the stock dividends don't touch assets at all. It only impacts the equity section by reducing retained earnings and increasing the common share account. So the total shareholders' equity would go down, the retained earnings, and up in the common shares. It would be a net impact of 0 on total shareholders' equity. So I'm going to say that once more. The cash dividend, the overall impact is that retained earnings goes down and total shareholders' equity would go down and assets would go down. However, with the stock dividend, there is no impact on assets and no impact on total shareholders' equity because one of the accounts, retained earnings, goes down, but the other account, common shares, goes up. Okay, so when you have your class on Thursday with Professor Baxter, if there's anything you want to chat about with any of this, he'll be able to answer your questions and talk about it in a little bit more detail if you need more detail. But let's carry on and move on to how we sort out the updated balance sheet for this one. So I'm going to write the new balance sheet directly below here. So you don't absolutely have to write this part, but we'll call this partial balance sheet. This is at December 31st, 2019, so a year later. So this is our shareholders' equity section of the balance sheet, and we have our preferred shares. You can put a comma or semicolon between each little segment here in the description. These are $1 preferred shares. You don't absolutely have to write the authorized, but this is 500,000 authorized, same as before. But now instead of 200,000, we have...
Sorry, madam. There is
No, sorry. Sorry about the interruption there. We have 300,000 shares. And this is, you can write issued and outstanding as that abbreviation. So what is the dollar amount? We started with 4 million, and when we issued our new preferred shares, we added $1 million. So now we have $5 million on the balance sheet for preferred shares. Okay, so now we can write our common shares. This is unlimited authorized. And we had 1 million shares the year before, but we issued another 500,000 shares. And in addition to issuing the other 500,000 shares, we also issued another 15,000 shares when we did our stock dividend. So our total common shares now are 1,500,015. That would be issued and outstanding. So just to review that amount again, we had 1 million shares issued and outstanding, but during 2019, we issued an additional 500,000 common shares, the number of shares, and with our stock dividend, we issued another 15,000 of new common shares. So that's a total of 1,515,000 common shares. What about the dollar value? So the dollar value started at 10 million. We added another 5 million, so now we're up to 15 million. And we added another, so we want to look at this particular item. And with our stock dividend, we added another 165,000. So our total dollar amount now for our common shares is 15 million. 15,165,000. Okay, so what about our retained earnings? For retained earnings, we need to look at a couple of things. We need to do a little side calculation here. So I want to point out a few things with retained earnings. Retained earnings during the year has gone down by the amount of the preferred dividend, 300,000, and it's also gone down by the amount of the stock dividend, 165,000. But it has gone up by the amount of our net income. Okay, so we have three impacts on retained earnings. So if we were doing a statement of changes in equity, we would have a column for retained earnings. And what I want to do is just jot down that column and show you the increases and decreases to retained earnings. So we'll do that just below our journal entries here. So here are retained earnings. We started our retained earnings, the beginning of year balance was 250,000, which I'm taking from the balance sheet from the year before. So 250. So we'll subtract the preferred dividend first. So that was 300,000. We'll subtract the common share stock dividend next. That was 165,000. And then we will add our net income. And our net income was 520,000. The order doesn't really matter too much here. Usually the dividends are listed above and net income is last, but as long as we get the right final balance, that's all that really matters. Just going to quickly do this calculation. Okay, so we're starting with 520. Sorry, not 520. We're starting with 250,000. We'll subtract 300, subtract 165, and then add our 520 net income. Okay, so our ending retained earnings. So once again, this would be a column in your statement of changes in equity. So our ending retained earnings is 305,000. And now we can put that on the updated balance sheet. And now we can get our total shareholders' equity by adding those three items. So total shareholders' equity will be $20,470,000. Okay, so that is our first example for the shareholders' equity section. The only item that we have not done in our journal entries would be a common share dividend. And I have one more example I'd like to go through just for practice. So I'd like this video to be about, I think, 45 or 50 minutes, maybe 60. And before I go on to the next example, everybody's going to get this handout, so you'll have this video to listen to as well as the handout to read through while you're listening. So the second page of your handout, I tried to make some notes for you, so just recap what we have talked about and add a few new items just for your just for completeness for the chapter. So again, preferred shares. Another difference that I had not mentioned earlier between preferred shares and common shares is that preferred shares, when it comes time to have a vote with the board of directors electing new members, or if they're voting on a management item, preferred shares do not get a vote. However, common shareholders do get a vote. They usually get one vote for every share that they own. But preferred shareholders do not get a vote. So once again, the other main difference between preferred and common shares, preferred shareholders get a fixed dividend amount, which is stated. Common shareholders, the amount of the dividend is not fixed. There's a couple of different types of preferred shares, which have to do with the payment of dividends. If the company comes across a year when they don't have enough cash to pay any dividends, preferred or common, if you own a cumulative preferred share, you could get your payment the following year for 2 years of dividends that are owed to you. However, if you have a non-cumulative preferred share and we go 1 year without paying any preferred share dividends, then you've lost that money and you'll get your dividend payments the following year, as long as there's enough cash. So once again, cumulative preferred shares, this is when you are owed the dividend amounts for your preferred shares for all the years that the company was not able to pay them. The money would go to preferred shareholders first. And non-cumulative, if there's a year they don't pay, then you've lost that dividend money. Okay, so balance sheet format we have gone through. Just for your information, on the balance sheet, the dollar amounts that are shown are the issue price of the shares. The dollar amount on the balance sheet has nothing to do with what they're traded for on the TSX or other markets. Stock dividends we have gone through, and these are your notes for how to calculate the stock dividend. A stock split is interesting, but it is only something you need to know in theory. First of all, there's no journal entry for a stock split, and it does not impact the balance sheet. So the balance sheet, other than the number of common shares, would increase. But the dollar amount on the balance sheet would stay the same if there was a stock split, and there would only be, if there was a stock split, there would only be a note in the financial statement. So let me tell you what a stock split is. A stock split, if we have shares, and this is typical for banks, sometimes on the secondary market the shares might be trading at 60, and a couple of years later they go up to 90, and then they maybe go to $100 per share. And when we get up to about $100 per share, that gets to be a little too expensive for people to purchase shares in blocks of 100 or 1,000 at a reasonable price. So what the company would do is they would do a stock split. Usually it's 2-to-1 stock split, or it can be 3-to-1. And what would happen is if the company had, say, 400,000 shares issued and outstanding, that would be the number of shares, before the stock split. After the stock split, they would have 800,000 shares issued and outstanding. However, the stock price would be cut in half. So after the stock split on the secondary market, you would be buying your shares for $50 instead of $100. So for a stock split, the only change on balance sheet is the number of common shares. This does not happen with preferred shares, only common shares. It's the only change. So when you have your balance sheet written out, the only change would be this number here. If it was a 2-for-1 stock split, that would go up to 2 million shares issued. Everything else would stay the same here. If you're an investor, if you were an investor and you owned one share, and at the end of one day your share was worth $100, on the next day you would look at your account and suddenly you would have 2 shares of that company, but they would be for $50 each. So you still have the same dollar amount for your shares, but you have double the number of shares as an investor, and they would be worth half as much. So it really is a wash, and it's really more a theoretical item for you to know about, rather than something we need to write a journal entry about. So there's no journal entry, no impact on the financial statements other than the number of shares. Okay. So what I'd like to do is go through this example with you as a second example quickly. In this example, we're going to write journal entries, and we are going to look at a statement of changes in equity as well. So let me just center this so you can see it. Is that big enough? Okay, so we have, this is ABC Company, we have a partial balance sheet at the end of 2017, and then the items we're going to look at, actually, I think I might do a different example with you instead of this one. Yeah, I'm going to do that one. We're going to do this one. So this is one of the examples in your textbook. So this is our balance sheet. So I'm just going to label this up here clearly. This is shareholders' equity section, our partial balance sheet. We have common shares, and we don't have any preferred shares in this example. So we have 500,000 common shares that were authorized and 300,000 shares so far that are issued. So this is as of the end of 2016, and we have our dollar amounts. During the following year, 2017, we're going to look at a 5% stock dividend. We're going to issue additional common shares at $12 a share. We're going to look at cash dividends that were declared and paid, so this would be for the common shareholders, and net income, which will impact our retained earnings. Okay, so let's look at our stock dividend first. So our 5% stock dividend, do the calculation here. So we're going to take 5% and multiply by the number of existing shares. We don't have dates for these items, so we're going to assume that they happen in chronological order. So the stock dividend was first. That will matter when it comes down to paying the cash dividends, but our amount is given. Our stock dividend is 5% of 300,000 common shares. Again, this is the number of shares, common shares. So 5% of 300,000 will be these 15,000. I'm just going to double check to make sure that's correct. So that will be 15,000 new common shares. And to get the dollar amount, we take the 15,000 shares times the market price on the date of declaration, which is $10. So that equals $150,000. So now we can write our journal entry for the stock dividend. So that journal entry will be, we decrease our retained earnings by $150,000, and we increase our common shares by $150,000. So that is the stock dividend, all done. The next item is we're issuing 20,000 additional common shares for $12 a share. In that case, we're going to get cash, $240,000. So this is just the 20,000 new shares multiplied by the $12 and our increase in common shares. There's no journal entry for the net income amount. We can leave that off. And they've given us the dollar amount for the cash dividend for common shares. But what I'd like to do with this journal entry is just imagine that we did it on two different dates, date of declaration and date of payment. And we'll break this down into two journal entries. So the first one would be if there was a date of declaration, and it normally is date of declaration. We would have the decrease to retained earnings of $100,000, and the increase to, we would just say, dividends payable. So when it's a common share dividend, we can just say dividends payable. If it's a preferred share dividend, we would say preferred dividends payable. So it's as simple as that. And then on the date of payment, our journal entry would be the debit to our dividend payable and our credit to cash. Okay, so if we combine these two journal entries, the same impact would be here. It basically reduces retained earnings and reduces cash. The payable account is just temporary in between date of declaration and date of payment. Okay, so this is a sort of a shorter example. That's everything for the year. And what we can do, and I'd like to show you next, is the statement of changes in equity. So, excuse me, if we had preferred shares, we would have another column here for preferred shares, but we don't have preferred shares. We're just going to start with our common shares. So, our common shares started at $870,000 the year before. That's our beginning balance in common shares. We issued another $240,000 of common shares, and we issued another $150,000 in common shares with the 5% stock dividend. So just to refer, so for these two amounts, we can refer back to our journal entries. That was the stock dividend, and this was the new issue of 20,000 common shares. Okay, so both of those items belong under the common shares column. So our final dollar amount for common shares, so this is dollar amounts, is $1,260,000. So that's great. So retained earnings is separate. Our retained earnings, we started with $680,000 at the beginning of 2017. We reduce our retained earnings by the amount of the cash dividend and by the amount of the stock dividend. And then we increase our retained earnings by the amount of our net income, which was given in Part C. So our ending retained earnings is up a little bit, so $750,000. And so now we can write the balance sheet. I'm going to squeeze this in just below here. For our balance sheet, it will be shareholders' equity. This will be at December 31st, and it'll be 2017. So we're going to have, we don't have any preferred shares, we're going to have our common shares. You don't absolutely have to put in the number authorized, but just for completeness, 500,000 authorized. Now, how many shares do we have issued and outstanding at this point? So back up to the original, we had 300,000. How many shares did we add here for our stock dividend, and how many shares did we add when we issued the new shares? This was 20,000 shares. Common shares, and when we did our stock dividend, we added 15,000 common shares. So once again, as long as you're keeping track of the number of shares, you don't have to write this down if you have a question like this on your exam, but it helps to be careful at this point so you get the number of shares correct. So we are going to have 35,000 additional shares, so that will mean we have 335,000 shares issued and outstanding. So what is the new dollar amount for our common shares? To get the dollar amount, we can look at our statement of changes in equity. It's right here, so it's 1,260,000. For our retained earnings, we have our retained earnings amount from the statement of changes in equity. I didn't really talk about the total column here, but if we have a total column, we just add everything across. So the only item, so for completeness, if you do have a statement of changes in equity, then just add everything across for this total column. Issuance of common shares, cash dividend is one item. Notice the stock dividends have zero impact on the total shareholders' equity, because common share goes up, retained earnings goes down. We have our net income, our final, we'll call this total shareholders' equity is 2,000,010. Okay, so that is everything as far as examples for this chapter, and there will be at least one more example for you posted on Brightspace, and at least one more example that Professor Baxter will go through with you on your Thursday class with Chapter 19. This is one of the questions that he will discuss and that you can review ahead of time. So this is question 28 in your textbook. So thanks everybody for listening to this video. I know it was a long one. And good luck with this. If you have any questions at all, please email me. I will be able to reply to emails, and if you need an audio answer, I'll be able to send you a little audio file that could be perhaps 1 or 2 minutes, maybe 3, as another option for a reply. So either email or video. Thanks very much, and we'll go on to Chapter 10.